Okay, our focus today will be on an introduction to climate finance. And what's the content? We'll start with an opening thought about what climate finance really is. And we go ahead and talk about why does climate finance matter in this time and age. After which we look at key objectives. And the sources of finance is quite crucial, so we need to know the sources of climate finance also. Then we'll talk about the climate finance instruments such as bonds, equity, and a couple of other climate finance instruments such as sustainable loans too. Then we'll look at the global frameworks governing climate finance, such as the UNFCCC, which is the UN, United Nations Framework Convention on Climate Change. And we'll talk about how important the Paris Agreement was in moving finance towards climate change operations. Then we'll look at the role of financial institutions as it pertains to climate financing. Then how climate risk affects finance. Also, we look at the upside of climate finance, which is the opportunities. And we'll talk about challenges too in terms of the opportunities of climate finance. Then we talk about the peculiarity of Africa in terms of financing climate operations. Then we'll give a case example. Then we'll come with some key takeaways and we'll end with a conclusion. An opening thought is if climate risk is not priced into finance, then finance itself is mispriced. That means if climate risk is not embedded in our finance of today, then we might be signaling the wrong ideas to even our investors or the public in general because of the social cost of carbon. Also, we'll talk about the rising cost from climate disasters. Climate disasters are happening in droves and it's quite impactful on businesses, both on the financial and the impact it has on business. Also, we are moving into a net zero economy or a sustainable economy in terms of the future generation. So climate finance needs to be geared appropriately. Then the financial decisions shaping the future. The future is sort of going green. So we need to channel our funds into sort of the burgeoning renewable industry. So, what is climate finance? Climate finance refers to funding used to address climate change. So, in essence, it talks about the mitigation and adaptation finance. So, mitigation finance are sort of a finance that limits our greenhouse gas emissions, while adaptation finance is more geared towards building climate resilient structures in terms of resisting climate impact. Also, this finance can come from both public and private sources. And it could also be blended finance, whereby the public is sort of more of a philanthropic act and the private sector interacts together. So the risk and return can actually be managed to an appropriate level. So money that enables climate action, it's called climate finance, whether it's for mitigation or adaptation purposes. Why does climate finance matter? Climate finance matters because climate change in itself creates economic risk. This economic risk can affect different sectors. Take, for instance, the agricultural sector. It might affect the yield. This might have a major economic impact on nations. So, climate finance needs to be geared towards the appropriate sectors. Also, climate finance requires trillions of dollars in investments. Take, for instance, the new collective quantified goals of the UNFCCC is quite explicit in terms of channeling trillions of dollars into climate finance through the green climate funds, whether it's for mitigation or adaptation control purposes. Also, climate finance matters because it helps support sustainable development. We need to look after the future generation. As McCartney calls it, the tragedy of the horizon. So we need to look futuristically. So climate finance also matters because it helps drive the transition to a net zero economy. So we need to move into a renewable economy. What are the key objectives? climate finance aims to reduce greenhouse gas emissions. So our greenhouse gas emissions needs to be controlled. So one of the reasons why we actually finance climate operations is to reduce our greenhouse gas emissions. Also, we need to adapt into climate change system because of our buildings need to be resilient from climate impact. So things like dams need to be built across a lot of rivers or beaches because of the impact or physical impact it might have on buildings. And floods too could actually have serious impact on premiums of houses along coastal regions. Also, climate finance aims to promote sustainable growth for the future generation. What are the sources of climate finance? We actually have various sources of climate finance. We could be public, most likely from government. So things like the NCQG, which is the new collective quantified goals, is sort of pushing trillions. A bulk of them will come from government. That's from government of the developed countries. Also, climate finance will come from multilateral institutions such as the World Bank, which is quite a key public multi-development bank in terms of financing and climate operations. Also, private sector investment is quite crucial in terms of climate financing because, as I've emphasized earlier, there's opportunities in the climate sector. So a lot of private investments will need to be involved in terms of moving into a net zero economy. Also, NGOs and developmental agencies are quite significant sources of climate finance. So, what are the climate finance instruments? There are a lot of climate finance instruments, such as the green bonds. A lot of countries, especially the advanced countries like China, is quite a leading or in light years ahead in terms of climate finance green bonding, which is quite a key factor. So, green bondings can be issued by nations or corporate entities. So, it's sort of a debt instrument. Also, a key climate finance instrument could be equity, whereby a lot of venture capitalists or angel investors could decide to invest in renewable sources of energy or renewable economies. Quite a key factor, whereby people could buy equities into renewable source of energy generation. Also, instruments like sustainability linked loans, green loans are quite crucial. They could be cheaper in terms of the interest, but they could be instruments in terms of moving into a net zero economy. Also, carbon credits. Carbon credit is sort of a cap and trade policy whereby there's you could sell the excess of emissions in case you actually go below the threshold. Carbon taxes could be very viable instruments in terms of managing our climate finance and moving into a net zero economy. What are the global frameworks that governs climate finance? There are very key global frameworks like the Paris Agreement that was held in Paris in 2015 was quite a crucial agreement in terms of funding climate finance operations, be it mitigation or adaptation finance, but it's actually spearheaded 195 parties or countries into thinking how to finance climate operations and reducing global warming below 1.5 between 1.5 degrees Celsius, looking at the industrial levels of emission. Also, the UNFCCC is quite crucial. That's the United Nations Framework Convention on Climate Change in terms of financing climate operations. And they actually use the auspices of the Green Climate Finance in Green Climate Funds in terms of financing climate change operations. And UN's NFCC was actually formed in Rio de Janeiro during the Earth Summit, which was actually sort of vested with moving climate operations or having mitigation and adaptation finance in terms of moving countries into a net zero economy. Sustainable Development Goals was born out of the Millennium Development Goals, and the SDGs 13 is quite emphatic about climate actions. What do we need to do about climate action? Because climate action calls for actually investment in finance. What is the role of financial institutions in climate finance? Financial institutions help allocate capital to green projects. So there are a couple of taxonomies that actually defines green projects. So with financial institutions, we help us allocate capital of funds to green projects. Also, it helps assess climate risk. So things like principles for responsible banking, principles for responsible investing, or the incubator principle helps integrate climate risk or ESG risk into climate investments. Also, it helps influence corporate behavior. So, what are the climate risks in finance? Climate risk is actually anchored on two major risks, which is the physical and transition risk. The physical risk will come in two lights, which is acute and chronic. The acute risk are sort of severe short-term risks, such as flood and drought, which will have high impact, whereby the chronic risks are long persistent risks, such as precipitation levels and temperature levels or global warming, which could actually have a long-term impact. Also, transition risk could range from policy and legal risk to change in demand and technology, which could actually have great implications for climate finance. So the physical risks are more geared into the adaptation finance, whereby the transition risks are geared into mitigation controls. So, what are the opportunities in climate finance? Just like as I've emphasized, climate finance comes with also upside opportunities. So, it's not only the risk we should be looking at, we should be looking at the opportunities. What are the opportunities? The renewable energy investment. So, the renewable energy investment is burgeoning. Things like solar systems are quite new entrants into this market. So, it is creating a serious opportunities for investment. Also, green infrastructure, which is more geared into the adaptation controls from green buildings, are creating opportunities in terms of the real estate industries. Also, innovation and technology, fusing climate risk and climate finance with technology could create a different industry on its own, which is the climate technology industry, which is can create a lot of opportunities in the future. And job creation in terms of green jobs is sort of a growing industry or sector. What are the challenges of climate finance? And one of the challenges of climate finance is the global funding gap because of the inequality in terms of resources and finance. So the less developed countries will probably need assistance from the developed countries. Also, there's lack of reliable data from economic indices to firm level data. We do not have a lot of data in terms of climate finance. Also, policy uncertainty because of the uncertain nature of climate change risk. Policy is sort of uncertain, so it can change and alter and actually affect climate finance. Also, greenwashing concerns. A couple of firms or nations could actually greenwash in terms of save reputation. So this could be actually a sort of an ethical side towards climate finance. So, how does climate finance impact Africa? Africa, in its right, is sort of positioned geographically in a way that climate impact or risk is sort of conspicuous in terms of its operations and economic production and consumption also. So, climate finance affects Africa peculiarly towards its indulgence or reliance on things like agriculture and also sort of fossil fuel industries, and also its lack of capital. So things like huge investment needs is sort of a gap whereby Africa needs finance in terms of um, dealing with climate risk. Also, infrastructure gaps. We need to adapt into climate resilient buildings and structures in terms of dealing with climate risk, and also the strong renewable opportunities or potential. Just like as I've emphasized, where there is risk comes an opportunity. So there's sort of an opportunities in terms of the renewable energy potential of the African market. Also, reliance on international funding. The African economy is reliant on international funding to fund a lot of projects. So this might be a major shortfall of the climate finance in Africa. Also, case example, the solar energy investment. The solar energy investment is sort of a mitigation control and it helps reduce emission to a great level, and it provides affordable electricity. So it's sort of an alternative or a substitute for normal AC currents in the house. So the solar energy is sort of a burgeoning industry, and it could help spur economic growth, which creates a lot of opportunities in the future or in less developed countries. The key takeaway: why does climate finance connect, or how does it involve the economic or financial system? Climate finance involves movement of funds or money, and it also has impact. The impact could be in terms of dealing with risk and the opportunities it creates in the future, and it could help look after the future generation in terms of investing in climate resilient buildings and mitigation controls, and creating opportunities that can actually help even the health and the future generations in terms of sustainable development. And what's the closing or ending or the conclusion is: what role should you play in climate finance? As an accountant is geared or bedeviled or actually has the responsibility to identify, to actually measure and report climate risk. So they are ethically obliged because climate risk is fast becoming material. Both we are looking at the impact climate has on the business and also the impact the business has on the climate. Also, as finance professionals, whether it's public or private finance professional, we need to fund climate projects, whether it's mitigation or adaptation control. So how do we channel these funds? How do we get these funds? Where are the sources from? Quite a key factor as finance professional, and how we help manage climate risk in terms of funding. Then as strategic business leaders, climate finance or risk comes with opportunities. What opportunities are the business leaders taking advantage of in terms of probably investing in climate technology, in terms of actually investing in new technology that sort of spearheads or creates a new industry entirely? So it could be fusion of the artificial intelligence with climate technology. So it creates a new industry for the business leader into the net zero economy.